Hello, ladies and gentlemen. Welcome to Modern Financing. My name is Sasha Starr, and I have today our distinguished guest, Milan Somberg. Doctor, welcome to the show.
Delighted to be here.
Oh, there's a lot of noise. Um, okay, Milan, can you hear me?
Yes, I can. Yeah.
Okay, very good. So we are going to talk about a lot of things today. I would like to remind you that our goal is number one, number two, and number three, preservation of capital. So this is our foremost aim while investing in stocks or bonds or just anything. Preservation of capital is number one. So for that purposes, we have divided our portfolios in two parts. Is large, much larger parts, 90%, in some cases 95%. It's bulletproof investments, such as S&P 500, which is so far the best selection of U.S. stocks mostly. There are some Canadian stocks must be there as well, maybe even some European, but I'm pretty sure it's S&P 500 US stocks primarily. And also we have fund portfolio with 5-10% invested, where we want to have profits. Fun is probably just as important. So this is where you can make intelligent decisions, but in a way you can allow yourself to be more adventurous, take bigger risk, and sometimes unfortunately, we have to pay for this extra risk, as we all know. But if you have fun, it's well worth it. You have to pay for fun, whether you're going to movies or you're going on a 30-day trip to Europe. It will cost you money, right? So in this case, this little fun may cost you some money. On the other hand, on a trip to Europe, you're not going to make any money, but you will have a lot of fun. So here you can have a lot of fun while occasionally making money. Milan, what are your thoughts on that?
Exactly what you say, Sasha. You're talking about a fund portfolio which should be of a size so that should we lose it all, it won't make any difference to the way we live. We can have a lot of fun. Nobody needs a fund portfolio. We can do very well following the 6 habits that we talk about. So a fund portfolio, let's talk about a fund portfolio before I start on that. I mentioned that the 6 habits are: number 1, is save. Without saving, the other 5 don't work. Number 2 is do it yourself. Number 3 is buy the American market as a whole, no stock picking. Number 4 is buy and hold, no trading. And so I'm going to dwell for a minute about number 2, which is do it yourself. We need advisors for a whole lot of things. We need advisors for tax issues and life insurance and trusts and tax planning and annuities and mortgages, a long list of where we need advisors. But when it comes to investing, money management, we don't need advisors because it's a very simple thing for us to pick the best, safest investment that there is, which is the American economy as a whole. It has produced the best results for over 100 years. Unless we go into cherry picking, you can say, yeah, San Francisco real estate has done better. True. That's cherry picking. Toronto real estate has done better. That's true. Some stamps have sold for more. That's true. Some violins have sold for, the record for a violin now is $16 million that somebody bought 50 years ago for $20,000.
And also don't forget cellos. that can do very well also as an investment. You
Exactly.
know, the advantage of cello is it's much bigger. You know, the funny question is, what's the difference between violin and viola? Well, some people
Viola
say
is
viola is bigger, right, a little bit than
five
violin,
tones lower.
and
Five tones lower.
it
Mhm.
has lower pitch or so on. But they forget the major difference is that viola burns longer than violin.
Yeah, that's an important difference. But
Yeah,
in the business of do-it-yourself, uh, the record shows that for any 30-year period, the S&P 500 has gone up over 1,000% for any 30-year period. During the same 30-year period, the average mutual fund has gone up 240%. How low? What's the difference between 240% and 1,000%? Where is that difference going? Is it going into the pockets of investors or into the pockets of Wall Street? Yeah. So when it comes to money management, we don't need advisors. So it's an important one to know because doing the right thing, the most risk free, safest investment, and nothing is really risk free, but the lowest risk, safest investment would be buying the American economy as a whole. It has a record of over 100 years. Professor M. Lloyd Dimson from the London Business School has studied that subject carefully and has shown that to be the case. And will that be the same in the future? Well, all prospectuses have to say that past performance is no guarantee of future performance. That's a requirement, But Confucius did say, study the past if you will define the future. So that's a pretty good way to go about it. So
absolutely.
I want to mention a couple of things that I talked to our members about. And
You're talking about members of Monday Morning Millionaire, right?
yeah, the members of Monday Morning Millionaire are primarily professionals in healthcare. Primarily, half are Americans, half are Canadians. They are dentists, my colleagues, and pharmacists, and surgeons, and veterinarians, optometrists, and so on. And we have some people who are simply businessmen. So those are our members, and they are all very aware of the things that I'm saying here now. So uh, I'm going to say a few words about what I've recently been posting for our members. And one of them is we talk about the advanced stock market investing. 5 advantages. One is the returns are the best there is, unless you cherry pick. Number 2 is absolute total liquidity, instant transactions. Another one is excellent record keeping that will satisfy the tax man. And another one is low transaction costs. The low transaction costs today are so low that we can ignore them, totally ignore them. But that has resulted in a lot of market activity, which is what Wall Street wants, and which very frequently is a mistake. Because when we had transaction costs that we had to think about, we would think before we made investment decisions. And we think much less now because investment decisions are devoid of cost, no transaction costs. So while that can be an advantage, pretty cheap to buy and sell, whether you buy $1,000 worth of securities or $1 million, the cost is next to nothing either way. So while that's attractive, it also results in so much activity, exactly what Wall Street wants. There is a huge difference between what we want and with what Wall Street wants. So that's something that we need to be aware of. Now, um, I want to say a few words about initial public offerings. The record shows that after 3 years, almost zero initial public offerings are selling for more than they came out with. That's not when we buy an initial public offering. Who are we buying it from? We are buying it from people who have built up a company and they want to cash in their chips. They know more about the company than we ever will. They want to cash in their chips, and we are buying an almost zero initial public offerings.
On expectations that there will be even a bigger fool who will buy the shares from you at higher price.
That's right.
And there are some exceptions. For example, Facebook, when it went at $23 a share, went down to 16 or 17, and we know how it's much worse now. So there are a few exceptions.
Well,
Now, one thing I would like to clarify: when you're talking about investing in American economy, you are referring to S&P 500.
yes, yeah.
And remember that there is a very small but still cost, because essentially it's nothing more than just a mutual fund which automatically invests only S&P 500 stock in a certain proportion, and there is a very small, very tiny management fee, which is neglectable
Exactly. Yeah.
compared to mutual funds. Like we normally pay much higher fees, sometimes 2%, sometimes whatever it might be.
Mutual funds also have a whole lot of added costs that we're not aware of.
Oh, absolutely.
Marketing costs and management costs and payment to salespeople who make much more than exchange traded funds are traded among individual investors one to another, where mutual funds are sold by an organization which has entry fees and exit fees and management fees and advertising fees. The list is quite long.
There is also a question of how they're successful in promoting and advertising their funds, because without that, there will be very little liquidity. For S&P 500, you don't have to worry about that, because there are millions, hundreds of millions of people who are trading S&P 500 units all the time, all day, all week, and so on and so forth.
So indeed, that's true. Yeah. And so that's what we recommend. And also, we can teach a high school student in less than 15 minutes how to acquire S&P 500 by buying an exchange-traded fund which tracks the S&P 500. A good example would be SPY, very low cost. And then after you acquire it, keep it until retirement. And so the rules are simple enough to teach a high school student how to do it. But Wall Street wants us to think that we need them and that what they do is brain surgery or rocket science. And that's not the case at all. So now you wanted to talk today about puts and protective puts.
Yes.
And so a protective put really is much like life insurance, except it has an expiry date. So we pay for life insurance for good reasons, and the best time to take out life insurance is the day before we die. But protective puts are very much like life insurance. People who buy protective puts want to protect a portfolio, want to protect an aspect of their portfolio. So say they have a certain security, doesn't matter what it is, and they acquire it at a nice price, and then it goes up, and so now they're concerned about losing some of the gains, so they buy a protective put, so that if it goes down, they can put it to the seller of that protective put, and it's a form of life insurance, really, except it has an expiration date. So you can buy these things for a year ahead or 2 years ahead, and so it's useful, but it doesn't make much sense if you invest the way that we recommend in this Monday morning program, which is to buy the American economy as a whole by buying an exchange-traded fund which tracks the S&P 500. Because if that's the case, that two other issues. One is we should be aware of the fact that money which we are going to need in the next 2 or 3 years to buy groceries and pay the rent, that money does not belong in the stock market. So that's number one. And number two, we should have an asset allocation balancing ownership of the American economy as a whole and cash or near cash. And that ratio should be something like 50-50 or 60-40 or 45-55. Not important. The important thing is time in the market. How much does Wall Street make on any cash that we don't have invested? Zero. So they want us, and they're constantly urging us to invest everything and to invest all the time, including money which we're going to need in the next couple of years. So if that happens, there will certainly come a time when we will have to sell at a price lower than the price at which we acquired the security. That will happen Sure.
Milan, I think you forgot about Wall Street that they all want us to enhance our profits, to take loans or equity loans or mortgage your house and invest this money also in stocks. So they will make even more money, and your position could become quite precarious because if things are not going your way and you mortgage your house and everything is all your assets are going down, we don't want to be in that situation at all.
A very successful investor who studied with Warren Buffett's mentor, Benjamin Graham. He's older than Warren Buffett. He's a very successful dentist. He died a few years ago. And what he advised is to have a 50-50 asset allocation. And if the market drops 10%, put half of your 50-50 into it. That's called a variable asset allocation. If the market drops another 10%, so it's down now 20%, put all of your money into it. And we were just about there recently. We were there recently, actually. And if it drops another 10%, borrow to invest. That's not something that any financial advisor would recommend. Neither would we, unless people have the risk tolerance to handle that.
Yes,
Personally,
agree.
personally, I'm doing that, but I cannot advise that to others unless they can sleep at night doing that sort of a thing, because you know that the market will return. You know that in the short range, short term, the markets are dangerous. In the long term, they're the most productive place to invest, as Elroy Dimson has shown for a very long time. In the short term, cash is very safe. In the long term, cash will lose purchasing power guaranteed. Governments want to see roughly a 2% inflation rate, because when we buy bonds from them, they sell us bonds. We give them $1,000. They are going to return that $1,000 to us 5 years from now, 10 years from now, 15 years from now. We'll get interest throughout that period. But when we get our $1,000 back, it buys a lot less than it did when we lent it to the government. So,
And there are some taxation issues on the interest that
oh
will.
yeah, nothing. Yeah, there's where we need advisors. We need advisors on taxation issues for sure.
Absolutely.
Yeah, that's a problem. So, protective puts, we don't need them because we want to see. We're just as happy to see the market dropping because we can buy bargains, as we are happy to see the market rising because we can take profits. So, this business of variable asset allocation, where the more the market drops, the more we put into it. And if it drops 30%, we borrow to invest. We can only recommend that to people who have a high risk tolerance and who can sleep at night doing that. Maybe they can do that with part of their portfolio. Maybe they can do that with their fund portfolio, so that it's a portfolio the size of which should be such that if it gets totally wiped out, it won't make any difference to the way we live.
Well, that's where comes preservation of capital. It's aim
Yeah.
number one, number two, and number three. And talking about protective puts, and you compared it to buying insurance. But the who makes most of the money is sellers of insurance. The insurance company are doing tremendously well by selling insurance, satisfying people's desire for protection. And if you can act as insurance company by selling those puts, you can do tremendously well. In fact, copying the strategy of the insurance company. I'll give you an example. Recently, not I'm doing a lot of selling puts, and for example, if you take some very strong stocks, like one of them is Nvidia, one of my favorite stocks, and they're reporting at the end of the month, and we'll see what they will do. But let's see, stock today is over $185 a share or something. So let's see, would you be willing to buy Nvidia at $150 or less? Of course, if stock is at 185, I want to buy as many shares as possible at 150. How to do it?
And you have researched it thoroughly, and it is a stock that is reliable and might get 3 or 4 stars from Morningstar, high rating. The analysts think well of it. You think well of it. Yes, you want more.
So I'll tell you, I'm a little bit skeptical about doing a lot of research on stocks because eventually you are looking at the information which is available to everyone. You don't have any edge by looking at their research because there are millions of people who are who are studying and reading the same research. So what's your edge? Everything is in the price of the stock. It reflects research. It
Yeah,
reflects the
you're talking about
dynamic movements. Everything.
the efficient market theory you're talking about here, right? Yeah.
Well, in a way, yes. Although there are some other people who don't believe in efficient market theory or so on, but it doesn't really matter. The stock and its price reflects everything what there is to it. So the only thing is, you may study the historical chart of the stock for last. I don't know. I'm taking last month, last year, for example, to see just the how dynamic the moves on that stock. Well, you can look at its beta and many other parameters, but again, it's all historical information available to everyone.
Yeah.
So my thinking is this: it's very practical. I don't read this research about Nvidia. Nobody needs it, at least not me. But some other people, a lot of people are spending 40 hours a week
Yeah.
reading all the research and studying and so on. I have a friend of mine actually, when he's buying stock, let's say he feels that he loves the stock, he loves the company or so. So he's buying, let's say at $100, he's buying, say, 100 shares, okay? When the stock going down to, say, $98, something he's losing a little bit of money. At that point, he's becoming a researcher. Now he gets all the material, he studies everything and so on. Not before, but after he's buying the stock. Because if the stock will go from 100 and 102, he will sell it right away to lock in the profit. When it
Yeah.
goes down to 98, then comes a decision. But you know my rule: if you are losing 7% from the initial purchase price, sell. Don't read anything. Don't think about anything.
Now, could I
Just
say something here, Sasha? If you are buying the American economy as a whole by
it's
buying an
Milan,
exchange,
it's a different story. I'm talking about individual stock.
oh yeah,
If
okay,
you're buying S&P 500, you can lose even 30%. It doesn't matter
yeah, yeah.
because in a
You know,
5 years and 10 years it will be higher. But individual stock, it's a very peculiar thing. The problem is that it may be a fantastic company in a fantastic market segment, but if it loses 7%, why it cannot lose 8%?
yeah,
How
yeah.
about 10% or 15%?
I agree with you.
Now you're in a hole. And the problem is, even that good company and a good stock, it will recover. The problem is that it goes a steep line down from $100, for example, a share, it goes down to, say, 85. From 85 to come back to 100, it will take several weeks, months, and maybe even a year or so. And you don't want to sit in that hole.
If a
Why
stock,
don't you take your loss at 7%, see what's happened next? Maybe it will start to recover. Now you can go back to that stock when it's on its up move.
uh,
And then you can start really making money from the day one. Now, 7%, that's all you can lose on individual stock. This is not my theory, I must admit. It's a theory of great investor William O'Neill. He has two fantastic rules. Number one, 7% loss, which is your maximum. Number two, never pay a margin call. What
no,
that means, you got a margin call, sell. That's
okay,
the only
okay.
thing that you have
So
to do.
you're talking about individual stocks here, and I
Individual
that,
stocks, absolutely.
let me mention briefly the dartboard portfolio. We talked about that before. A dartboard portfolio, because of the efficient market theory, which is something that Eugene Fama came up with about 30, 40 years ago, for which he won the Nobel Prize in economics. So ultimately, Professor Burton Malkiel, I think he was with MIT or with Princeton, yeah, he stated that because of that, a blindfolded monkey throwing darts at a stock page could equal anything that professionals could come up with. So the Wall Street Journal did that for 14 years. They had 6 months overlapping portfolios where Wall Street journalists threw darts at a stock page, and they compared that to the performance of all sorts of experts. And guess what? the dark port portfolio and the expert portfolio could not be distinguished one from the other. So that's what you have to do when you're picking stocks. And so we talk against picking individual stocks because of that. Because for every buyer, there's a seller, and both cannot be correct. If the stock goes up, the buyer is right, the seller is wrong. If the stock goes down, the buyer is wrong, the seller is right. They cannot both be correct. 50% chance of being right means a 50% chance of being wrong. Now, who would drive a car with a 50% chance of having an accident? So we say, why would you buy a stock when you got...
I'll tell you who are buying cars like that. In Russia, they're now making cars with practically no any protective equipment, no automatic transmission, no air conditioner, absolutely no nothing. And when there is nothing else to buy, unless you are prepared to ride a horse buggy, then you are buying this Russian-produced cars. That's not. But in stocks, we don't have to really go to such extremes.
Well, the important thing is, Sasha, and I think both you and I agree on this, that what you're talking about should be in our fund portfolio, which much of the time is not much fun and which nobody needs to do well. But occasionally we will stumble across something really worthwhile in our fund portfolio so that we can take some of that into our core portfolio when we are secure that it's going to work. So that happens. But if you want to gamble without going to Las Vegas or without going to Macau and doing it from home, this fund portfolio is a wonderful way to do it, so long as we put a limit. And our limit is the size of it. It should be of such a size that if we lose it all, we won't start eating cat food.
I want to give you an example of where I started with NVIDIA, for example.
Yeah.
So if stock is now 185, it can go much higher, it could go much lower as well. But idea of have a possibility to buy within certain period of time that stock at $150 or actually even less because of the premium which you will receive when you will start your transaction. I'll give you a very simple example. 150 put expiring in 20th of January 2023. You get premium of $10. So even the NVIDIA will go down all the way or so on, and you will be exercised at 150. But remember $10 that you received for doing this transaction. So your essential cost of NVIDIA will be only $140 a share. Now, most likely, well over 90% of all options expire worthless.
Yeah, right.
In this case, most likely you will end up with $10, which is on 100 shares, it's $1,000. And if you have 1,000 shares,
yeah, the premium income is enormous. The premium income on selling covered calls or
puts,
enormous. It's enormous.
Yeah. Exactly. So if you are getting so much money, which most likely will expire worse, and even if not, you will end up with NVIDIA stock at 140, which today costs 185, and it's depreciated actually quite severely in the last few months because it used to be well over $300 a share. So I don't think anything wrong with having an opportunity to buy that at 140. And the most likely scenario, you just simply pocket $1,000 in 100 shares.
Mm-hmm.
Yeah, all the premiums that you, and you can find similar position on other stock. Of course, maybe premium will not be as great as in this one, but your risk probably is less than in this example. Actually, sometimes last year I did some very aggressive selling puts. For example, if stock 185, I would sell 195 puts, which the premium would be fantastic. It's just gigantic premium, just incredible. And as a matter of fact, let me take a look. How much costs the same 100? Just for curiosity reasons, 195 puts, same expiration date, 190. Okay. You won't believe it's $25.60.
Yeah, unbelievable. But your prospects of having the stock put to you are enormous.
That's right. Okay, but let's do some calculation. If I'm getting $25 premium, stock is
Unbelievable. Yeah.
right.
For a month
So
now.
190 minus 25, we are talking about 165. So you will end up buying 165 your price.
Yeah.
Stock which is today is 185. So in the worst case scenario, you will end up with stock. Yes, it's not as good as 140, which in
Yeah.
previous example, but with the stock as Nvidia, I expect it to be well over $200 by the end of the year.
It's a stock that you want to own, so that's
And
important.
I want to own the stock anyway. The only thing is, instead of $1,000, I'm getting $2,500. That's the difference. And I know I'm a very greedy man, and sometimes I'm falling as a victim of my greediness. But that's all fear and greed, all the stock market.
How volatile is Nvidia? Because
Very much.
yeah,
It's very much
volatility is
volatile.
important.
It is.
Yeah, the more volatile a stock is, the more you'll get on covered calls or cash secure puts. Sure. Yeah.
Absolutely.
Yeah.
Nobody is going to give you any money for free. There is always cost associated. There is no free lunch.
So interestingly, the safest security that we talk about very frequently is the American economy as a whole, as reflected or as shown by the S&P 500. And occasionally, it has a very high volatility level. It has happened twice in the last decade. And when
Yes,
that high volatility level is in place, you can make enormous amounts of money for a brief period. So, that we advise our members who want to do this sort of a thing in the fund portfolio to check the volatility of any security that they're interested in. And the best way to check the volatility is go to a search engine and put down volatility of, and then put in your security in there, its stock market symbol or the name, and it'll show you the volatility. And the volatility is in the 40s, 50s, 60s. The returns are very high, as is
absolutely.
as
But
is.
again, it will show you previous historical data. You don't know what the volatility will be tomorrow. If volatility tomorrow will be less, this you will not collect $25 for your. You will
That's right.
collect only $21 or even less.
Yeah, yeah,
So this is, on the other hand, volatility could go much higher, and that put will cost $30.
yeah, yeah,
That's
right.
quite possible too.
Yeah, yeah.
So I have some Nvidia stock in my fund portfolio. The only problem with Nvidia, why I cannot put it in my core portfolio, is it pays negligible dividends, unfortunately. And again, reminding you that I'm a very greedy person, so I like stocks which are paying dividends for my.
And if you
my
move
portfolio.
securities from one stock to the other, it depends on a whole lot of things, whether you're talking about tax advantage portfolios or not. But you have serious tax issues to take into account.
Absolutely.
Yeah, and there I feel that I need an expert. Our accountant charges something at $300 to $400 an hour, and I think that our accountant saves me much more than $300 or $400 an hour. So
Mhm.
we need lawyers and accountants and various experts in various fields. We certainly don't need them when it comes to investing. Yeah.
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 Listen, you need professionals. Even if you need to pull out the teeth, you will not do it yourself. You will probably go to the dentist,
Yeah,
unless,
probably.
unless you're all self to do.
Yeah, yeah, right. Yeah.
But
Yeah.
I don't recommend that.
We are so used to professionals being much better than we are at anything. So if we can do some plumbing on our own and some electrical work on our own and some legal work and some accounting work, but professionals do a much, much better job. And we are so used to that being the case that we expect professional investors to be good at investing. And they're not. The studies show that over a market cycle, which is peak to trough to peak, very few professionals can equal buying and holding the S&P 500.
I
Very
totally agree with you, Milan. I think we had a very fruitful discussion today. We will have to concentrate on more puts and calls, covered calls, and
yeah,
cash covered puts, and how we can use it to our advantage in our fund portfolio, of course, in core portfolio. I always wanted to do it in my core portfolio, but I always restrict myself of doing so.
Okay.
That's why it is called core portfolio and why it's doing so well.
Yeah, yeah. Well,
Okay.
saving will not allow us to build up a fund large enough to retire on comfortably. We have to invest, absolutely, and we have to invest intelligently. And
Absolutely.
saving, we guaranteed loss of purchasing power or any money that we set aside.
Absolutely. And don't forget, with the development of medicine, unfortunately, people today live much longer than before.
Yeah,
So your life expectancy is much longer. So that's why financial planning and doing the right moves is so much important, because before, okay, you retire at 65 and you'll die at 70. So you don't
yeah,
have to worry so much. But today you retire at 65 and you may live to 90. So what you're gonna do? You don't want to even live that long, because
that,
probably your portfolio will not allow you to do so comfortably. So
that's what
it's very important.
that's what they call longevity risk.
Ah, yes.
Yeah, and longevity risk is a real situation. Bismarck, Otto Bismarck in Germany first introduced the idea of retirement planning. And in
Mhm.
those days, the lifespan was, I don't know, 65 or so. The life expectancy was 65. And he based his figures on that kind of life expectancy, knowing that very few people are going to make it to 70. Well, that has changed dramatically.
It is.
So that longevity risk is something that needs to be taken into account when it comes to our investing, knowing that saving alone will not get us there.
Yeah. Milan, thank you so much for the words of wisdom, and we will continue next week. We'll definitely talk more about options and about core portfolio. Remember that we are not giving any investment advices.
Yeah.
The only thing what we share is our own experience and our or some of our positions that we either already closed or presently still have pending, and you can see it for yourself whether it's something that you'd like to do. But again, thank you so much. Goodbye, everybody, and we'll see you next Wednesday. It's Modern Investing on Pod TV. Thank you very much. Bye bye, everybody.
Thank you for having me with you, Sasha. Thank you.
You're very welcome.